What is going on, investors? Hopefully, guys are doing well out there. I've got a fantastic opportunity for you today, particularly the buy and hold investor, and particularly probably a lot of you that are overweight tech, maybe even overweight speculative stocks. Well, I've got a fantastic opportunity that is setting up very nicely, and that is going to be, yes, the Home Depot company. This company reported their Q1 earnings before the bell. We will get into those. We'll take a look at the fundamentals, but we'll also look at this from a technical perspective as well. The longer term trend, but also the shorter term trend, setting up for an absolute smoking hot buy at the current moment. What we are seeing in the stock market is a rotation out of these types of names, and also the real estate sector continuing to be under pressure due to the rate hikes that we've seen over the past year. We'll talk about it in a minute as well. We've also seen commodity prices just come tumbling down as well. Both of those things impacting Home Depot. I think both of those things will resolve themselves over the next 12 months, making Home Depot a great opportunity for the investors out there. Now, what we have seen is a rotation in this stock market, okay? If you're like me and you're overweight tech, your portfolio should look exactly like this, okay? Year to date, up 21.5%. The Nasdaq's up 18%. The S&P 500 just up 7.75%. So if you are overweight tech, I think the rotation out of that sector is likely coming here relatively soon. That does mean the money is going to flow back into names like Home Depot, which have a relatively reasonable valuation, pay a dividend, executing on buyback, and have the tailwind of the housing sector likely coming back down the pike very soon. Now, over the last year, stock hasn't done that well, okay? Down 3.8% year to date, down 10% when you have many tech stocks up 50, 60, 70, maybe even upwards of 100% year to date. Now, company reported their Q1 earnings. Revenue came in at $37.3 billion. That was a decline of 4.1% year over year, and it missed expectations by $1 billion. If you're a subscriber to my newsletter, you got an alert about this company yesterday. Last night, I sent out this newsletter. In the video description down below is a link to my newsletter. You can subscribe. It is free. The midpoint guidance for Home Depot was 38.35, and I talked about how they put up $37.3 billion. I tell you what, that was even underneath the low-end estimate. And what is driving some of this revenue decline? Well, some of it is the fact that their commodity prices, 10% of Home Depot's business is actually construction material. And then when you factor in the construction material goes into other products that they have like flooring, it's well north of 10%, and we've seen lumber prices just fall off a map. On top of that, you see home builder sentiment that remains negative, mortgage demand at a 20-year low based on where interest rates are. But if you're like me and many economists out there, you think the Federal Reserve is at the least at the end of a rate hike cycle, if not at the start of a cycle where they start to bring down these rates. That should be a tailwind for home builders and the real estate business in general. Now, what is also driving Home Depot stock lower is their full year outlook definitely came underneath expectations. The last time we heard from this company back in February, they said that their sales growth and comparable sales will be approximately flat compared to the year prior. Well, they came out and revised that guidance. They actually think their comparable sales are going to decline between 2 and 5% compared to 2022. Also, the operating margin between 14.3 and 14%. Operating margin, essentially profit. Well, back in February, they said it was going to be 14.5%. That is because these companies are having to give additional compensation for frontline and hourly associates in order to retain them and stop them from going to work somewhere else and making more money. I also think we're towards the tail end of that type of cycle, as disinflationary and maybe even deflationary factors should contribute to these companies not having to continue to raise wages year after year, month after month in some cases. Now, again, we talked about this all on my newsletter that I handed out to subscribers yesterday. I've got Home Depot, I've got Target, and Walmart as well. Walmart setting up in a very interesting spot. We could be coming back on Thursday and having the same discussion there. Now, what you're seeing across the board over at Home Depot is a decline. Net sales, cost of sales, gross profit, all down in that 4% range. Now, the company did a nice job. This is why you've got to have confidence in a company like this. They did a nice job driving down their SG&A costs to the tune of about 4%. Depreciation and amortization did tick up, but that's a non-cash charge. We'll get to add that back in when we get down to cash flows. Our total operating expenses went down 3%, but I tell you what, your gross profit down 4.5%, your operating expenses down just 3%. That's going to drive down your operating income down 6.4% year over year from 5.9 down to $5.5 billion. Flow down to a net income number, and you are seeing the impact of those rate hikes. Interest expense ticking up 27% year over year. Also, likely going to be a tailwind in subsequent years ahead, as the Federal Reserve just simply cannot continue to raise rates at the pace that they have been. Your earnings per share down 6.6% year over year. From a balance sheet perspective, company doesn't have a boatload of cash, but has plenty of cash flow, as you'll see, to finance everything that they have going on, even in this difficult environment. The company has plenty of inventory on hand. In fact, they've done a relatively nice job controlling that. We talked about the fact that you have commodity prices just kind of falling off a cliff, and this is going to impact not just your lumbers, which this is a lumber future, but also steel, other metals that go into the appliance and all those types of things. All those costs should start to continue to contract over the next couple of quarters. Okay, they're not going to provide an immediate benefit for Home Depot, but over the course of time, certainly should start to normalize as those costs start to come down. Long-term debt, company has a boatload of debt, okay? And in a rising interest rate environment, that is going to show up. Now, what is positive about this company is their operating cash flows. The net earnings year over year went from $4.2 billion down to $3.9 billion, but we add back in depreciation, changes in working capital, and we get our net cash provided by operating activities actually up year over year from 3.8 all the way up to $5.6 billion. Very little spent on capital expenditures, as this company essentially has expanded into most markets that it wants to be in. So what do they use with this excess cash? They're going to pay down the debt. They're going to buy back the stock, and they're going to pay cash dividends. So that is going to keep the stock afloat to a certain degree. And then when you get those tailwinds of those rate pauses and eventually rate cuts and eventually a rebound in home building activity, a rebound in real estate activities, well, there's your tailwinds from a sales perspective. Not only that, once these commodity prices, these lower commodity prices start hitting the tape, as it does, there's some lag effect as these prices come down. It takes a while for them to actually show up on the shelves of Home Depot. That should help the company from a demand perspective as well. Now, from a technical perspective, folks, it's hard to see here. We'll maybe zoom this out to kind of a monthly chart, and you are going to see, folks, we are in a decade-long uptrend in this stock. And some of you might say, well, at some point that's got to come to an end. I guess you could have said that any time along here. And if that's your guess, then I guess you probably should be opening up a short position in Home Depot, which is dangerous considering the stock is paying a dividend and they have a buyback. But the old saying on Wall Street is the trend is your friend, until that good old bend at the end, and we're not seeing anywhere close to what would account or represent any kind of bend. Ideally, what you would actually like to see is this stock to continue to pull back a little bit more, maybe get back into that 270 range. That would put you on a level of multi-year support. This 265 level has held multiple times for the stock over the past couple of years. It would also converge with our upper trend line. Now, everybody's looking at the same charts. Everybody's looking at the same price action. So will the stock get all the way back there? Time will certainly tell. Now, the other thing that I am noticing is this stock looks like it's starting to reverse from a higher low perspective, and it is also making, while not convincing, higher highs as well. Wouldn't surprise me in the coming months ahead that we retest these highs back up here at 340, and that would be quite a move from where the stock is today at about 285. This is an area I like. I'm not completely in love with it. Wouldn't surprise me if the stock continues to trend down just a little bit more, because obviously the intermediate trend is very steeply down on this one. But given the strong fundamentals and the backdrop of the macro environment, where we are with commodity prices, where we are in this interest rate cycle as well, companies like Home Depot are going to benefit greatly. Money's going to flow out of short-term treasuries, money market funds, as those rates contract, and they're going to flow back into, quote, safe blue chip dividend paying stocks like Home Depot. This is not a fast money trade, but I think if we sit here a year from now, the stock is likely going to be higher. That was Home Depot. Hopefully you guys enjoyed today's video. Remember to check out my newsletter down in the description below. We'll see you again later this week. Good luck with your investments.